let's talk about December 9th. For anyone with an eye on the Indian stock market, it was one of those days you don't forget. We saw some serious drops, a few shocking surges, and just utter chaos. And believe it or not, it all kicked off with a huge problem up in the sky.
I mean, seriously, think about that. What actually happens? An airline that's a backbone of the country's travel network just stops. This wasn't some thought experiment. This was the reality that sent shockwaves from the airports straight into the heart of the financial markets. The result? A number that lit up trading screens in bright red all over the country.
And there it is, 436. That's how many points the Sensex, India's big benchmark index, just plunged. It was a direct, almost brutal reaction to the day's chaos, and a really clear sign that investor confidence was crumbling. This wasn't some minor dip, folks. This was a major shock to the system. Okay, so let's unpack what this sea of red really meant. This wasn't just a problem with one company or one little part of the market. Nope, this was, as they say, a market-wide bloodbath. Pretty much every major player felt the pressure. And the sheer scale of the drop was massive. Just look at the two big indices. The Sensex closed down more than 0.5%, then Nifty 50 wasn't far behind, dropping 121 points. Now, these aren't just numbers on a screen. They represent billions and billions in value just wiped out in a single day of trading. Now, while the airline mess was the spark, it really just lit a fire that was already smoldering. There was something much bigger at play, a global trend that's been putting pressure on markets just like India's. So what was the real driver behind all of this? 11,820 crore rupees. Just let that sink in for a second. That's how much money foreign investors sold off and pulled out in just the first week of December. When that kind of cash leaves the country that fast, it's a huge red flag for the entire market. So to really get this, we need to know who these FPIs are. These aren't just regular folks trading stocks. We're talking about massive overseas funds, the big institutions that manage huge pools of money. And when things get a little uncertain, they tend to pull their money out of what they see as riskier markets and move it somewhere safer. And when they sell like that, it puts a ton of downward pressure not just on stocks, but on the rupee itself. All right, so you've got this big picture pressure from foreign money leaving. But now, let's zoom right back in on the catalyst, the one story that completely dominated the headlines and really set the day's chaos in motion. At the very center of it all was Indigo, one of India's biggest airlines. And it was in a complete and total meltdown. We're not talking about a few cancellations. We are talking about more than 2,000 flights. The company said it was due to crew shortages, but honestly, for passengers and for investors, the reason didn't matter. The result was just pure chaos. And the financial price tag for all this chaos? Staggering. 38,000 crore rupees. That's roughly how much market value was just vaporized from Indigo's books in one day. A truly brutal hit for anyone holding their stock, all because the planes weren't flying. But this is where the story gets really fascinating. As Indigo was just nosediving, its rival SpiceJet saw a massive opportunity. While Indigo was grounding planes, SpiceJet was adding flights. As Indigo's stock was tanking, SpiceJet's was soaring. It was like watching a perfect case study of market forces play out in real time.
And this chart says it all, doesn't it? On one side, you've got Indigo stock just crashing down by a huge 17%. And right next to it, you've got SpiceJet shooting up by 14%. It's an absolute mirror image of failure and fortune, all playing out on one very turbulent day.
So you might think a day like this, with all that red on the screen, was just bad for everyone. But that is almost never how the market works. Even when things look bleak, there are always pockets of green. Places where some investors were having a very, very good day. Yeah, while the main stock indexes were taking a beating, a totally different part of the market was absolutely buzzing. The market for initial public offerings, or IPOs, was completely on fire, totally disconnected from all the pessimism going on elsewhere. Get this, 101 times. That's how oversubscribed the Equus IPO was. What does that even mean? It means that for every single share that was available, there were 101 people trying to buy it. That is just incredible, almost frantic demand. And why was everyone so desperate to get in on it? Well, because of numbers like this one, 39%. That was the expected listing pop. The profit investors were hoping to make on the very first day of trading. And yeah, that kind of potential return will get anybody's attention. But with all this chaos and excitement swirling around, it's really easy to get carried away. And days like this are exactly when the experienced voices step in to offer a little bit of a reality check. And this is some powerful advice from one of the biggest names in the business, Nitin Kamath. His point is super simple. Trying to jump in and out of a wild market like this one is, more often than not, a losing game. Making decisions based on emotion is a great way to wreck your long-term profits. And looking ahead, the experts are flagging a few potential issues. There's global uncertainty, especially with that big US Federal Reserve meeting coming up. That always makes the markets nervous. The rupee has been getting weaker all year, which isn't great. And there are some real concerns that the smaller companies might not post strong profits. So yeah, definitely some storms on the horizon to watch out for. Okay, so we've got the market drop, the airline drama, the IPO boom, and all these warnings. What is a smart observer supposed to do with all this information? Where are things headed from here? All right, so here's what to keep an eye on. First, all eyes are on that Nifty index. Can it hold above the 25,800 level? That's a huge psychological line in the sand. Second, experts are suggesting focusing on defensive sectors. The more stable stuff like banking and IT that people need no matter what the economy is doing. And finally, the one thing everyone seems to agree on, brace for more volatility. This choppy ride is probably not over yet. And that kind of brings us to the big final question, doesn't it? On a day like December 9th, what was the smartest move? Do you bet on the giant like Indigo to recover? Do you try to ride the wave of the opportunists like SpiceJet? Or do you just stay on the sidelines and wait for the whole storm to pass? It's a question that really gets to the very heart of risk and, of course, reward.